All right, welcome everybody to the Trading Apologist. My name is Tom, and thank you so much for joining us today. This is our very first stream, and this channel is really intended to be your home for all things swing trading, stocks, commodities, and crypto. Today, I'm going to keep it kind of short and sharp, just to give you an idea of why I'm creating this channel, who it's really geared towards, and then I also want to give you 3 rules that have really helped me in my trading that I think are going to be great to keep top of mind as we move into 2025 and continue to experience more volatility. So first, why another Finfluencer channel? I mean, I was going to do this short list like Crypto because I'm also German, but I figured I'm not as much to look at, so we'll just keep the shirt on for now. But this channel really exists because I saw so much content out there on YouTube that's geared towards day trading. It's TA in nature, and they have some great TA, but it's really for those short-term day trades, maybe a couple day trades. Then there are wonderful analysts who are doing some great work and deep dives into stocks and commodities, but they're geared more towards longer-term investing. And especially as we're moving into late cycle, we see more of this volatility. It's important to be nimble and take advantage of the mean reversion of the market. And by mean reversion, I mean that the market gets into these oversold and overbought conditions. And you don't just want to ride the roller coaster through all those dips. I mean, hodl is, the old saying in Bitcoin and crypto, but you really want to get in heavy and get in hard at those bottoms, ride it up, and then when there's euphoria out there and everybody's saying this is going to continue going up forever, start trimming your position, make the most of your portfolio. And as we look at global M2 increasing, I mean, just debasement, how much money printing there's been, how much purchasing power has gone down, it's more and more important to maximize your portfolios to outpace, I would say 14%. I'm going to get into that in my 3 rules, so we'll get into that in just 1 second. Before we do that, I want to talk about format really quickly. So I'm doing these pre-recorded to start because I'm not a trained broadcaster. Heck, I've been in the business world and investing for a couple decades now, but I'm not used to being in front of a camera. So I'm going to do this pre-recorded, and then the goal is eventually to do this as a live stream where you guys can ask questions and I can try to answer those and it can be a bit more interactive. But I also don't have time to do this every day. So the plan right now is 3 videos. So you can expect one at the start of the week. What's the market looking like for the week ahead, midweek check-in, and then an end of week wrap up. Where did we close? What are we thinking for the week ahead? What's the options action? And what's the futures market doing? So that's what we'll be doing moving forward. And with all that said, let's get into the 3 rules that I think are really important as we move into 2025. And this is why I titled the video, a little bit of a clickbaity title, but don't invest in 2025, because I don't think it's the time to hold positions. I think it's the time to be nimble. Now, rule number 1, high conviction and high concentration. As you start investing, I think it's easy to either buy index funds or just diversify yourself in too many positions. And both of those drag you down by weighing down your winning positions by the ones that aren't generating returns. For me, this means high conviction in a few names that I really believe in and high concentration in each of those. My last big deployment outside of things that I've been doing over the last couple of weeks as we've seen volatility was in late 2022 and early 2023 when I got in heavy and got in hard to positions like Solana, Bitcoin, MicroStrategy. I had Meta at the time, which I've since trimmed, and a few others. Anyway, I need to look at my list, but we'll get into it in other videos. But to illustrate this point of the importance of high conviction and high concentration, let's just look at this chart. Now, as I was putting this video together, friend of the channel, Invest Answers, posted this, and I thought it was very poignant. It's just breaking out the Magnificent Seven from the S&P 500. And this is looking back at 2023 and 2024. And now the Mag 7, in 2023, they had 106% return. In 2024, a 67% return. Really impressive. The S&P 500 as a whole did quite well also, 24% and 23% respectively for those 2 years, actually outpacing its average returns almost by double. But if you strip out just those 7 stocks and you're left with the other 493, those only returned 4% in 2023 and 6% in 2024. So at that point, you're not outpacing inflation and debasement for those years. Now, I should note, if we are being intellectually rigorous with this, that 2022 was a terrible year for the Magnificent Seven. Lots of these stocks like Google, Meta, they were down between 70 and 80% on the year. So this is what I'm talking about when I mentioned earlier moving into periods of volatility. You don't want to have a high concentration of your portfolio in those assets and then ride it down 80%. I mean, that's like being purely in Bitcoin. And I know that game, while I believe in it, is not for everyone. So with that, you can really see the importance of picking the right assets and what a difference that can make in your returns. Now let's go on to rule number 2. Before I do that, let me just see this other slide. Oh yeah, let's talk about this. Looking at historical returns for some of the assets I'm in and projecting that out to 2032, you can see that the compound annual growth rate, or CAGR, for Bitcoin is 36.9%, for MicroStrategy 44%, 55.2% for Tesla, and 49.35% for Solana. So that's an impressive CAGR projected out to 2032. We'll have to see if some of these assets are still around by then or how they're faring. Like Solana, for instance, has really disrupted in Ethereum in terms of being faster, better, and cheaper. But who knows what technology is going to be developed between now and then that might disrupt Solana. So you have to keep your tap dancing shoes on and be ready to move. Now let's move back to the rules. Number 2, don't overtrade. Now I'll go back to the webcam for this one because I don't really have a slide on it, but as I was earlier on in my trading career, I would find that I would get shaken out more in the market by downturns like we've seen the last few weeks, where I would sell and then I'm going to buy back in when it's lower, and inevitably you're filled with fear and you don't. So the importance of not overtrading means that you're getting in and building positions at really oversold points in the market. You believe in the asset enough that you can weather the storms of those undulations along the way, and you can ride it out for 18 or 24 months as markets recover. Not overtrading also means being conscious of your position size and not positioning too much of a portfolio, not positioning too much of your portfolio in a volatile assets where you're seeing swings that you just can't live with or you can't sleep at night. So you need to know your temperament, where your mental state is at, what kinds of swings you're willing to bear, and balance that with the high conviction and high concentration to build the portfolio that works for you so you can ride out the storm and just watch it grow over time. Now, going back to the last one, making at least 14%. Now, I would suggest you need to make a lot more than 14%, but I think 14% is the baseline to be treading water. And Carl B. Menger had a great post on this the other day where he was just looking back to 2020 and looking at debasement and how the US dollar has been devalued by that printing. It's been devalued by more than 363% since 2000. So that's an average of 14.5% devaluation per year. That's your purchasing power going down. So if you're not invested in assets that are getting you that return, then you're not treading water. Looking at that another way, the half-life of money, now this isn't on the slide, but it used to be said that the half-life of money was roughly 10.5 years. So every 10.5 years, say you had $100 now in 2025, in 2035, you would be able to buy $50 worth of goods with that same $100. But that has been accelerated by the money printing we've seen over the last 4 years. Since 2020 alone, $100 in 2020 is now worth just $47. So we've doubled, or I'm sorry, yeah, that time has been cut in half over this short period. And a good way to look at that is just by the income required to buy an average home. And this is for the United States, but I know it's true for Europe, for Australia, other places like that. So in January of 2020, you needed a salary of $51,646 to afford the average American home. That didn't go up much yet in 2021 to $51,747. But then as the money printing kicked in, see in 2022, $62,669, 2023, $86,184, 2024, $92,006. And 2025, things are leveling out a little bit to 92,553. So that's how much your salary would have needed to increase over that short 5-year stretch to be able to continue to afford the average American home. Looking at it from the inflation side, and I won't spend too much time on this, but we can just look at the average cost of auto insurance, up 55.4% since 2020. Homes up 52.3%, what we just looked at. Gas 43.3%. Oil 41.9%. We can go down the line, transportation use, cars, takeout, etc. But between those three metrics, there's a lot more to cover on the topic, but I'm hoping you can see how at least making that 14% clip is critical to your financial freedom and securing your financial future. Now let's go back to the 3 rules. I just have one last one, and it's a bonus rule. Don't hodl. And hodl comes, for those of you not familiar with crypto, it's a term that came from Bitcoin, from holding on to the asset through those wild swings. And I just saw a cute little meme on that. So average investor versus disruption investor. Average investor just freaking out at a 5% drop. And when you're in these risky assets, you can see huge drops and you kind of become numb to it. But I think it's absolutely ridiculous to just hold through those drops. As much as you can, you want to be watching the market. And when you see those mean reverted conditions to the top where everything is way overbought, start trimming your position. Everything in this market in life is a pair. Whether you're trading Tesla for MicroStrategy, one asset for another, or you're trading into cash. Ooh, I just got an alert on TradingView. We'll ignore that for now. So whether you're trading one asset for another, making that pair trade, or trading that asset for cash, if you're selling at the top and moving into something more stable like cash, and then you're not writing that down and you're able to buy 3 times that asset at the bottom, you're growing your portfolio exponentially. So I'm a huge advocate for pair trading, for swing trading, marrying those things together and maximizing your portfolio. And I hope we can do that together as this channel continues to grow. Anyway, thank you so much for checking this out. And I look forward to seeing you tomorrow as we dive into the first week of April and that countdown to tariffs on April 2nd, which I think is going to be an inflection point in the markets. I mean, that's going to be an inflection point. We really need to see if we're taking the path of 2022 with a longer drawn out pullback, or if this is 2018 and this dip was just a great buying opportunity and we have more upside ahead. I'm leaning towards the latter. We'll keep our fingers crossed and we'll see how things shake out over the next few weeks together. Talk to you later. Bye.